today, joining Civitas Strategies. DECAL is very generous in providing this information to all of the childcare business owners that they work with. Depreciation is something that often businesses do find a little complex or have a lot of questions about. And this is the perfect time of the year for you to be joining because we still have some time in tax season, right? So what we're going to learn about with depreciation is how what it is, right? Well, I'll tell you exactly in just a minute, but I want to give you a foundation for depreciation so you could have a conversation with tax preparers about it. I want you to be aware. So my name is Jen Vale. I'm the Director of Professional Learning. I'm joined by my coworker, Aaron, and our interpreter, Emily, to help you through our journey on depreciation. So, and again, depreciation, we talk to childcare providers at Civitas Strategies across the country, and it comes up very, very often. So we're going to show you that it's not that confusing. We're going to walk through depreciation. But before we start, let me just read our disclaimer that the information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but it does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and the recording of this content, including using AI or any artificial intelligence, are expressly prohibited, and only non-commercial uses of this work are permitted. I'd just like to just give you an important note, just so you understand who we are, right? Because I want you to know about the basics, of depreciation, when you could potentially need to prepare for higher taxes because things need to be depreciated. I want you to know all about complying with IRS rules, but this is for educational purposes. I do not want you to consider this to be tax advice. I am not a tax preparer. Civitas Strategies, we are not tax preparers. We educate childcare providers so that you can have these conversations with your tax preparer. So I just want to set that expectation. Excuse me. So we want to go over all of the details that will be most important to you about depreciation. So let's talk first about what today's conversation will include, and then we'll jump in. So there is just business in general, business owners who do have to file taxes, that depreciation could be complicated or confusing. And we're going to start today with exactly what depreciation is, because sometimes you may not really be aware of what it entails, right? What is depreciation there? Having to depreciate an asset or an improvement that you do in your business, it basically will affect, in many instances, how much of an expense that you can claim over time until that expense has been fully accounted for on your taxes. All right, so we'll discuss that in a second. I want to go over all of the steps that you take to determine if that asset or improvement needs to be depreciated. We have a simple decision tree. It's not difficult to determine if things need to be depreciated. So that's really important. And then how do we address depreciation on your taxes? And then what's fun at the end is that we actually are going to look at some special rules that you can discuss with your tax preparer that may be able to help you perhaps not have to actually depreciate something. So what you're going to find funny is that we're going to go over how you determine if something needs to be depreciated, what that looks like. And then I'm going to show you that the IRS does have some special rules where you may not need to depreciate something that normally would fall under depreciation. And then, we just want to make sure that you know what types of records you have to keep in order to have the right documentation for the IRS. So we'll go over that there. So what is what is depreciation? I mentioned it a little bit, right? So as you can see by the definition on the slide, it's a reduction in the value of an asset with the passage of time, particularly due to wear and tear. So let me make that definition just a little clearer. So depreciation is when the IRS determines that an item generally what has a lifespan of more than a year. So the IRS decides if something will last you more than a year. And if it costs more than $2,500, the general rule is that depreciation will apply and you will have to expense that purchase on your taxes over that determined lifespan. So really all depreciation is if something needs to be depreciated, it's taking the cost of that item and spreading it out over several years on your taxes, which the amount of years are determined by the IRS. And you actually can go to the IRS website. You can just Google IRS depreciation, and there are charts there that tell you in general how long the IRS thinks any type of purchase, an asset, a physical thing, how long they think its lifespan is. So they determine how many years we have to take the cost of that item and spread it out over that many years on our taxes, right? So why is that different than any other expense? Well, most of the time we're accustomed to having an expense that we write off in full the same tax year that we made the purchase, that we had the expense, right? So most business expenses, allowable business expenses, you get to take off in full that year on your taxes. But when depreciation comes into play and we're thinking about having to take that expense over several years, that means that the year in which you purchased that item, if depreciation applies, you're not going to be able to take the total cost of that expense that year. So our taxes are probably not going to be lowered as much as we expected if we have to depreciate something, right? So we're used to taking it all in one year and it offsetting our revenue, right? This amount of the expense and depreciation, we're looking at it at expensing it over a period of time. When we talk about depreciation, we are talking about, these are just some examples, but anything that is over $2,500, we start with a lifespan of more than a year, we start to think about depreciation. That could be furniture, appliances, computers. It could be improvements and renovations on a building. And if you use a vehicle more than 50% of the time for your business, that vehicle is possibly subject to depreciation. So what we're going to do is let's do a little bit of a dive into this, because as I just mentioned, right, why do we need to understand it? It's because we could potentially have an expense that that is not going to be completely offset that year. So, a large expense, we would hope that we could take it in the same year, but this could change our taxes, right? So just so you know that when we think about depreciation, it's about the cost and the lifespan per item. So if I were to buy let's say I buy 50 chairs and each of those chairs is $100. Well, since that chair is only $100, I don't have to depreciate it, even though that chair would last more than a year because it's under the $2,500 threshold. So we're talking about the individual pieces, not that huge purchase of all of those chairs that I made. So in that instance, right, even though that big purchase of chairs was over the $2,500, I'm still going to be able to take that expense in the same year because the per chair cost was under $2,500. But when we think about depreciation being offset because something needs to be expensed over several years. So let's say you used $20,000 of your revenue and you purchased what would be $25,000? Trying to think of a single thing. I mean, let's say you bought a huge bookcase or something along those lines, right? We made a big purchase of one thing over $2,500. So in that instance, whatever the lifespan that the IRS has determined for my huge bookcase, right, that I put in my business, whatever the IRS has determined that lifespan to be, that $20,000 expense is going to be divided up by that number of years. So I'm not going to get to take $20,000 in 1 year. We're going to go over some rules where we may be able to do that. But in theory, under the laws of depreciation, that $20,000 is going to be spread out over however many years the IRS determines. Let's just say that the IRS determined that we could only deduct $4,000 a year for that $20,000 bookcase. So that year that I bought the bookcase, that $20,000 in revenue that I used to buy the bookcase, we're not just expensing that $20,000. We're only going to expense the $4,000. And what does that mean? There's $16,000 in revenue that we may have thought we were going to have an offset expense, and we'd be paying taxes that year on that $16,000. Now, depreciation can be great because now we're getting an expense that we get to take over multiple years, and maybe we have a year where we don't have a heck of a lot of expenses, and that $4,000 is going to be great. But when we first make that purchase and we're so used to being able to take the full amount of that expense, we could get a surprise at tax time, right? Because we thought our taxes were going to be adjusted by that $20,000, and they're not. So that is why you need to understand it, because depreciation affects your taxes often over many years, I'll say there. And again, if you go to the IRS website, you will find, you have to dig a little bit, but you'll find how many years the IRS says all different kinds of items, how long they will last. And again, they determine that. You don't get to determine that, they do. So thinking about depreciation and everybody saying, oh, it is so complex, there actually are a series of questions. We're going to actually see a little decision tree, little chart that will basically put all of this together. But I'd like to go by step by step so that we can determine if something needs to be depreciated. So basically, the very first thing is the item ordinary and necessary for your business? Well, if it wasn't, it wouldn't be a business expense, right? So, we certainly would not be expensing something that isn't ordinary and necessary for the business. That's the IRS's definition of an allowable business expense there. Now, we do know that you'll be able to, and I'll show you there, we're going to go over what we have to take into consideration here. But, if something is not ordinary and necessary for your business, chances are it wasn't a business expense to begin with, and you wouldn't have been taking it off your taxes. So once we've determined that, what's that next question? Well, as I mentioned, the next question is, hey, that item that I purchased, can it last more than 1 year? So if we had something like paper towels, I buy a lot of paper towels, but chances are they're going to be used up in a year, or they're going to be used up over the course of 12 months strung together there. That's not something, regardless of how much that cost, we're not depreciating the paper towels. But if we bought a desk, and again, it would be over the 2,500, we'll talk about that. But if I bought a desk, that desk will exist and function for more than 1 year. So we have to start to think, is this going to be depreciated? The same case would be if you were making an improvement on your home. So there are home improvements for family child care, as well as facility improvements for centers that could potentially have to be depreciated, that you may not be able to take the whole cost of that renovation or that improvement in 1 year. So it's not just items, but also improvements and renovations can be subject to depreciation. So our next question, let's say we said it's an eligible business expense. Oh, and this item definitely could last more than a year. Now, is the value of that item more than $2,500? So anything under $2,500, regardless of its lifespan, you basically will be able to avoid depreciation. So when we hit that $2,500, then we need to think about going through the rest of these qualifiers for does something need to be depreciated. And keep in mind, the $2,500 is a per item limit, right? Again, if I buy a ton of chairs, but those chairs are only $100 each, I would not have to depreciate that purchase of all of those chairs. So when we get to this point, did it cost more than $2,500? And if it did, we're going to move on to see other things to take into consideration there. If this purchase, if this perhaps work that you've done on either your center or your home, if it is a repair or maintenance and not an improvement, right? It's not going to increase the value of your home. It's not going to be a better version of something that you already had and you're replacing that. It's not going to be, if it isn't an addition, an expansion, things like that. If it's a repair or a maintenance cost, it is not subject to depreciation no matter how much it costs. So think about if you have something that is addressing some type of work being done in your facility or your home, think about the fact, is this a repair, or is it repair maintenance, or hey, am I making a big improvement to my facility or my home? Because if it's a repair, it doesn't need to be depreciated. So you want to think about that. An example would be is, let's say there was a windstorm and I had to replace some shingles on my roof. I'm not redoing my entire roof with a much better type of shingle, right? I'm just replacing some existing shingles on my roof, the same type of material. It's not basically inflating the cost of my home or improving the cost of my home. Even if that cost $3,500, because it was a repair, part of maintenance, right? We don't have to depreciate that $3,500. We're able to take it all in 1 year. Sometimes it's difficult to think about things as to whether it was a repair or maintenance. So you really want to stop and think, hey, if you replaced something, did you replace it with something of greater value? If you replaced, maybe you changed a kind of amazing water heater that everybody who's looking to purchase homes or businesses, they're looking for that. That's an improvement. That increased the value of your home. If the old water heater broke down and we needed to repair it, we don't have to worry about depreciation no matter how much that cost. So I'd like you to kind of think about that. If you had a situation where you had some old cracked tile and you replaced them with a tile of the same value, that's a repair, right? We didn't improve it. But if all of a sudden I put down hardwood flooring, that's an improvement and could be subject to depreciation. So you have to stop and think when it comes to perhaps improvements and things like that in your business. Just, we're going to decide improvement, repair, or maintenance. I'm going to just kind of go off on a little tangent here about for family childcare providers, right, who are using their home. If you have a purchase that is only used for the business and you determine that it needs to be depreciated, that would be 100% of an expense that would be depreciated. But if you have any type of purchase or improvement, right, that is in that mixed space, which is what is considered to be regular use space shared between the business and your home use, your personal use of your home, you're not going to be able to take that entire expense and depreciate across time. You have to use your time space calculation first, right? So if you have something that is let's say more than $2,500, it's going to need to be depreciated, but the amount that it needs to be depreciated is determined by your time space calculation. So that $2,500 rule still stands. And then we're going to use time space, and we're going to take the percentage that basically going to use the percentage to calculate that there. Now, one thing that is also very appealing to home-based childcare providers is that your home can actually be depreciated. If you're running your business out of your home can be subject to depreciation. It is definitely something that you want to speak to a tax preparer about. It basically is about the home itself and not the value of the land. So what you can do is you can go to your local assessor's office, and they can tell you how much that land is worth. And then you are going to subtract the land from the value of your home. And then that remaining amount is what would be potentially subject to depreciation. So if I purchase my home for $400,000 and I go to the assessor and they say, hey, $75,000 of that purchase was for the land. Well, that means that my total depreciation amount on my home is $325,000. So the reason that I encourage everyone, if you have a home and you're running your business out of your home, to think about home depreciation is because there's actually a tax law that if you've been running a business out of your home and you sell your home, you actually have to, how do I put this? When you sell your home, you are going to pay taxes as if you depreciated the home or not. So that's why it is so crucial to please speak to a tax preparer if you are a family child care. If you haven't depreciated your home so far, please speak to a tax preparer, because since a business was run out of the home, taxes when you sell the home, there is an assumption that it was depreciated whether you did depreciate the value of your home or not. And that's why it's really crucial to speak to a tax preparer when it comes to our homes. So I just want you to think about that. This is just an example of what charts on the IRS website look like, right? So basically, we have what's called straight linear depreciation, and you'll see a list of saying to you, hey, this item is going to, in our example here, that item is worth has a lifespan of 15 years, and it cost me $15,000. Well, $15,000 now needs to be divided over 15 years. So this is how the calculations work. This is a really straightforward calculation, right? Because it's $15,000 over 15 years. That's $1,000 a year for 15 years that I'm going to be able to claim on my taxes. So the IRS sets basically the lifespan, right? As I said, and just in general, office fixtures, furniture, equipment, things like that, the IRS considers the lifespan of that to be 7 years. With automobiles, with vehicles, they consider it to be 5 years. Improvements to land, which get very, very tricky because are they allowable improvements for the business? And you definitely want to speak to a tax preparer about that. But the IRS rule is that if an improvement to the land needed to be depreciated, it would have to be depreciated over 15 years. Your home, or your home basically that you're using in part for a business, you have to depreciate it over 39 years. If you are a landlord, there are different rules for homes that you rent out. There are different rules for people who have purchased their facility for their centers. So we always do want to speak to a tax preparer when it comes to home building, all of that type of depreciation. But knowing what you know now, you'll be able to have a conversation with a tax preparer about, hey, have we been depreciating my home? Am I going to have to pay taxes as if I depreciated my home? And keep in mind that it's going to be your time space percentage of your home value, right? We're not going to be able to depreciate the entire amount of our home because time space is involved in that. So you also are going to be reminding your tax professional, hey, I use this for business and I use it for my personal use, and they're going to figure out the depreciation for you, how that what that amount will be over that course of the 39 years. And we're always going to make sure that we've had removed the cost of the land from that. So just kind of keep that in mind. There are some other ways that depreciation can be calculated. And I know you're going to say, well, why am I here if you're telling me to go to a tax preparer? Well, when we find qualified tax preparers, they are good as gold. If you've ever had difficulty, as have many childcare business owners, had difficulty finding a qualified tax preparer for your business, it can be a little tricky, right? Now, you may find somebody who really is on the up and up, but maybe they don't totally understand time space. You do. You understand your business. You're going to be able to discuss it with them. You're going to have resources from DECAL that they post on the Thriving Childcare Business Academy site. There's all sorts of resources there that you could share with a tax preparer. I'll go off on another little tangent in that we do know nationwide finding a tax preparer, especially for family childcare businesses, is really tough. So what I do ask is that if you have a great childcare business tax preparer, share it in your community. Let others know that this person is available. If you don't have an experienced childcare tax preparer and you've had issues in the past or you just don't feel confident, reach out to your community and say, hey, does anybody have somebody that's really well qualified, somebody that you feel, and remember, it's not a tax preparer who saves me money every year. It's a tax preparer who understands childcare business taxes, especially for family childcare. So it's not easy often to find a qualified tax preparer. If you have a bookkeeper, you may want to ask your bookkeeper, especially if they deal with other childcare businesses, hey, do they know of anyone, a reputable and experienced childcare tax preparer? You can ask if you have any legal, anyone, a lawyer or anyone like that. You can ask if they happen to know, because often professionals are connected with one another. So, but often it's your community that's going to be the best resource. If you are on, if you have a local Facebook group for childcare providers, throw that out there. And again, I ask that if you have somebody who's good, you have confidence, you know they understand time, space, business use of home, they understand all of the allowable expenses, pay it forward and share the name of that tax preparer. You may have to ask their permission first. Maybe they're so busy they can't take on anybody else. But there's my little tangent for the day, because I hear it as somebody who does tax education with childcare providers across the nation. Sometimes, often, it's the number one question that people have. Can I recommend anybody? Civitas Strategies cannot recommend anyone. We don't keep a list of tax preparers, but your community is often the best resource for this. So I throw that in there only because when we need to have our home depreciated, and when we have these tricky depreciation situations, it will benefit us if we have, obviously, a qualified childcare tax preparer. So just want to bring that up. Now, we went through all of this. I'll revisit the steps, and we're going to look at a little decision tree just to make sense. But okay, is the item necessary for an ordinary for my business? Yes, it is. we move forward in the decision-making process. Can the item last more than a year? If it is, we move forward in the decision process. Is it, as the value, the purchase of it, over $2,500 per item? Yep, I'm going to move forward in the depreciation process, and then I'm going to determine how many years does the IRS say this particular purchase, what's the lifetime, right? Over how many years do I need to depreciate it? So I go over all of this with you. We explain depreciation, and then I come in and I say, hey, everybody, there are methods that are called, that basically are used for accelerating depreciation. What does that mean? There are ways that everything could fall under those circumstances that we just went through. And there are IRS tax laws that could potentially allow you to not have to depreciate something. Jen, why did you just go over all of this? Well, a tax professional may have a strategy for wanting you to depreciate something, or you may have a purchase that doesn't fall under these accelerated methods. But I want you to know about this because it is possible in many instances to accelerate depreciation, meaning taking it all in 1 year. So we went over all of that now. I'm like, and this is not cheating, right? This is an allowable IRS law. So there is something called Section 179 depreciation. So if you're thinking about having a conversation with a tax preparer about whether or not something needs to be depreciated, please write down Section 179. They will be able to walk you through this. So Section 179 is for physical property, allowable business expenses for things like office equipment, furniture. It also can include vehicles, but I'm going to actually talk to you about another form of accelerated depreciation that is better for vehicle purchases. So we'll talk about that there. So if I bought something and it's used more than 50% of the time for my business, right? Family child care provider, if I made a purchase, it's used more than 50% of the time, I could potentially use Section 179 depreciation. If I'm a center, whatever allowable business purchase I'm making is used for the business 100%, right? So we don't have to think about the 50% or more use. It's going to be an allowable expense there. So what happens with accelerating depreciation or Section 179 is actually in 2024, because we're going to talk about thinking about 2024. That's the tax season that we're in, even though we're in 2025. In 2024, you actually have the ability to add up purchases up to $1.22 million and use Section 179. That's a great number, right? I mean, the chances are of us having made purchases over that $1.22 million in a year might be pretty slim. And if you and your tax preparer have determined that Section 179 accelerated depreciation is for you, you're going to be able to take that expense in 1 year. Everything we talked about, you may not have to do. In 2025, it goes up to $1.25 million in total expenses, right? So everything added together. And then we could use Section 179 depreciation. So if you think about it, right, there are a lot of purchases in your business that even if we went through all those different steps and determined, hey, this is something that would be eligible for that I would possibly need to depreciate, your tax preparer can use Section 179 in many, many instances. But keep in mind, this is physical property. All right. There are rules for Section 179 for vehicles. What we're going to do is let's jump over to what's called bonus depreciation, because bonus depreciation, another method of accelerating depreciation, allows you to depreciate more of a vehicle's cost in 1 year than basically you could using Section 179. I right now, just saw this slide has a mistake. So bonus depreciation has been set up by the IRS that it's a percentage of an expense over in 1 year. That percentage changes from the time bonus depreciation was put into place till it expires. So I apologize. The 2024 tax season, you are able to deduct in 1 year, not having to depreciate something, 60% of the cost of that asset. So keep in mind, right, Section 179, we were able to do the whole cost up to that $1.22 million. So if we chose to use bonus depreciation, we're not going to be able to take it all in 1 year. It would be in this year 60, yes, 60% for 2024. In 2025, that percentage falls to 40%. And in 2026, it's 20%. And as of right now, tax law is written for bonus depreciation to end at the end of 2026. So as of this moment, there is no bonus depreciation in 2027. I will tell you that tax law changes sometimes often, and you will always want to make sure that you are aware of current tax code. Perhaps bonus depreciation gets extended. I can't weigh one way or the other if that's going to be the case there. So with bonus depreciation, right, we know it's this percentage. What's interesting is that the item can only have, not including your home, the item cannot have a useful life of more than 20 years. So if you had something that the IRS determined the life of the item was more than 20 years, that would not be subject to bonus depreciation. Homes, buildings are not subject to bonus depreciation. All right, so keep that in mind. And as always, if you're a family child care provider, you would have the total cost of something minus the percent, in this year, 60%, and then calculate time space on whatever the 60% of that expense is. So you can see that Section 179 is very, very attractive in many instances. Bonus depreciation is going to get us less of an amount that we can take all in 1 year on our taxes. The difference from bonus depreciation and Section 179 is when it comes to vehicles. And I would very much like you to speak to a tax preparer about using bonus depreciation for vehicles, because they actually determine the amount of depreciation that you can take on, the amount you can claim, on a vehicle in 1 year, depending on the weight of the vehicle. So if it's a passenger vehicle and it's 6,000 pounds or less, there's one amount that you can take in a year, and it's the year that the vehicle was put into business. And yes, you can do this with a used vehicle. However, you do have to be using that vehicle more than 50% of the time for business. So that's the qualifier there. Then there's another amount that if your vehicle is over 6,000 pounds, but less than 14,000 pounds, there's an amount that you could take. And there's a situation when vehicles are over 14,000 pounds. There is also then another, it may not be a set amount. We're finding large SUVs often are falling over that $14,000. This is where we talk to a tax preparer, right? Because it's nice that we might be able to take a large chunk of our vehicle expense, the year that we put the vehicle into use for business, in 1 year, rather than having to depreciate it over. IRS had 5 years for vehicles. Now, if your vehicle was over the amount, the cost of the vehicle was over the amount that they allow for between 6,000, over 6,000 pounds and under 14,000, the difference of that can then be depreciated over time using bonus depreciation. So it doesn't mean that if something costs you more than what the IRS allows between that 6,000 and 14,000 pound amount there. The balance of that could potentially then be depreciated using bonus depreciation for the remainder of the years, because we know vehicles are obviously very, very expensive. If you are splitting the use of your vehicle between home and business, please think about that 50% business use and be prepared to show documentation. So how am I going to document that I use this vehicle more than 50% of the time for business? It means I'm going to have to record and track all of the numbers that that I use that vehicle for, including my personal use, right? So, and every business trip I'm going to record. So let's say at the end of the year, I use the vehicle, I drove the vehicle for everything considered 20,000 miles. Well, more than 10,000 of that has to be for business in order for me to depreciate the vehicle. And when we talk about depreciation for shared vehicles, that's how you determine the percentage, right? You'll know then the percentage of time. And that percentage of time is going to be the percentage of the cost of the vehicle that you are going to be able to take in 1 year, right? So if I use my vehicle 75% of the time for business, I'm allowed to use bonus depreciation to expense it all in 1 year, but I'm only going to be using 75% of the price of that vehicle. So when they are shared between business and personal use, keep in mind, it's not going to be the entire amount of the purchase. If we're talking about a vehicle that is not used at all for personal use, then yes, it would be 100% of the cost of the vehicle. I want you to be very, very careful in claiming that a vehicle is used 100% only for the business, because the IRS can come back and say, all right, what was the starting mileage at the beginning of this year? What was the end mileage? And show me, okay, great, that was 20,000 miles. I want to see 20,000 miles worth of trips. I want to see that the grocery store was 10 miles. So the IRS has the right to ask you for this documentation. So, all right. Now, the last form of accelerating depreciation basically is about improvements and renovations, right? Not repairs. We already said we don't have to depreciate repairs. In terms of, it's called safe harbor. And it's not a large amount of an improvement or a renovation. It's actually only up to either $10,000 or what they call 2% of the unadjusted basis of the home. Well, we know about unadjusted basis because that's the value of the home minus the value of the land. So whichever amount is less, $10,000 or 2% of the unadjusted basis of my home, that is the amount of the total amount of an improvement or renovation expense that we could take in a year. All right, so if I have a home, let's say the home itself valued at $300,000. Well, actually, let's remove 2%. Oh, I apologize. Oh, yes, $300,000. My notes, I messed up on my notes a little bit. So what is 2% of that amount? Well, it's $5,500. That's less than $10,000. So using safe harbor, I'll only be able to take to claim $5,500 in 1 year for that improvement or renovation, regardless of how much it costs, right? I can only claim that $5,500 in a year because 2% happen to be $5,500, lower than $10,000. So whichever is lower, that's the amount you can take in 1 year for safe harbor. So we'll never be able to expense more than $10,000 of a renovation or an improvement expense using safe harbor. That $5,500 is basically aggregate. So if we looked at expenses and we had something that was only $2,000. 2% of it was $2,000. And then 2% of another expense was $3,000, as long as it was under the 2% of my 2% of my unadjusted basis of the home, I would then be able to claim both of those expenses, right? So just kind of keep in mind that there is, whether it's the 2% or the $10,000, whatever is less, that's the amount. When a tax preparer file safe harbor for you, you're going to see that there is a kind of like a little declaration that you are going to be using safe harbor. It's very, very simple. Technically, it's called Section 1.263, the de minimis safe harbor election. And there's a little section that would on your taxes that would actually that you would be submitting. Your tax preparer will know all about it. It's not difficult, doesn't ask you for a ton of things, but it is something that if you are going to be doing safe harbor, you can expect that you will be providing this somewhat a statement saying that you're taking that. So that's all the accelerated depreciation. So there are a lot of times, right, when we don't have to you actually depreciate something if our tax professional determines it's in our best interest. When would it be in our best interest to not accelerate depreciation? Well, if we had a year with a lot of expenses and we kind of think that the coming years we're not going to have a lot of expenses, boy, spreading out the expense over the course of several years may make sense. And only a tax professional can help you determine that. So please, I hope that when you are going into this tax season, that you have these conversations with a tax preparer. What you see here on the screen is all of the things we just talked about broken down really easy. Step number one, is it ordinary and necessary for your business? No, it's not a business expense. If it is yes, we're going to go down to the next we'll go to the next situation, right? Can the item last more than a year? If no, we don't need to depreciate it. If yes, is the asset over $2,500? If no, we don't need to depreciate it. If yes, now we're going to come down to, well, was it a repair or maintenance? If the answer is yes, we don't have to depreciate it. If the answer is no, that it was not a repair, then we're going to think about, are we going to depreciate this or are we going to use a method of acceleration, right? So we're going to think about Section 179. If it's an asset, a physical thing, if it's a vehicle, we're going to think about bonus depreciation, and you can use bonus depreciation also for physical things. But remember, it's just a percentage of the cost of that vehicle. Was it an improvement or was it an improvement or what else? What was the other word? Renovation. If it was an improvement or a renovation, then we can potentially consider safe harbor, but understanding we have that limit, right, of either 2% of the unadjusted basis of the home or the $10,000, whichever is less. The vehicles, again, I'm going to encourage you to talk to a tax preparer about that, but often bonus depreciation can be the way to go with vehicles. If it is a home or center purchase, we are going to have to depreciate that. There's no accelerated depreciation for residents or facilities, right? Nope, those are going to go through the amount of years that the IRS determines that needs to be depreciated. If we have improvements or renovations over that either $10,000 or 2%, we're going to have to depreciate that. Accelerated depreciation does not apply. So it's always a good idea when you have something that falls under those categories, or those steps. We go through there, like, oh, I think I have to depreciate this. Well, let's talk to a tax preparer and see, am I eligible for Section 179? Bonus depreciation, safe harbor depreciation. And then your tax professional can help you make that decision. Now, one thing we want to make sure, if you're ever going to be either accelerating or depreciating something, keeping documentation is crucial. You already know this for expenses, right? We know that. But the IRS can come back and ask for any of this. So whether you accelerate or you depreciate, you need to have the record of what exactly was the item, what's the total cost. If it is business and personal, used for both business and personal, something within the home, we buy a new table that needed to be depreciated or something like that, and the children eat at the kitchen table. We buy a new appliance shared between my business and my family, big refrigerator, over $2,500. I potentially can use Section 179, but what I need to do is on the proof of purchase, I need to calculate what percentage of that expense is an allowable expense using time space. So another great reason, right? If we're a family childcare business, we need to know time space inside and out. All right, and you would be recording all of that. All right, so please just keep in mind with taxes, record keeping is essential. Doing it throughout the year can save you so much of a hassle at this time of the year, having a really good record keeping practice. And it is so crucial for all businesses. Family childcare businesses can be there can be more scrutiny because of perhaps the abuse of the time space calculation. Not that I think anybody here does that, but we do at Civitas, we get to hear about audit situations and things like that. So this is the type of record keeping that you would keep. So we have a few minutes for questions. We're going to do that in just a second. I just want to make sure. So today, now you can understand what depreciation is, how it affects your business and your taxes. How do you depreciate an item? Do I have to depreciate an item? And what does acceleration look like? So we went over that. I'm going to bring this next slide up before I take any questions, because if we have questions that we don't get to today, or you think about after the webinar, and this recording will be posted on the Civitas Strategies YouTube channel, and we also do give it to DECAL. But if a question comes up, please visit tomcopelandblog.com. Civitas Strategies, we are the stewards of Tom Copeland's blog. There's over 1,500 resources. You may be able to find the answer there. Or there is an option there that says Ask the Experts. And you can click on that and submit your question. I am trying my best to get those questions, answers to those questions, recorded in a video that is posted, basically so that everybody can see the answers to everyone's questions. Obviously, tax time, we're running short. I'm trying to get those up on a weekly basis. So I do my absolute best to do that. So just going to put up this so that you can see, oh, I want to do the next thing. This is our YouTube channel, over 600 videos. You can find everything that we've ever done with DECAL happens to be there. So having said all of that, Aaron, do I have any questions? Do we have anyone with a question?